Hello and good morning, everyone. The world of financial markets can be a bit overwhelming and sometimes difficult to trade. We at Almus try to make this aspect of your business a bit more sane and a bit more peaceful through our activities. Welcome to Almus Market Mornings, one of the activities we use to achieve what we just mentioned. With me, Shikhar Garg. Talk about overwhelming, we look to the kind of moves currencies and equity markets are giving. Euro well below parity, GBP down further, equity indices dropping more than 2% or in similar cases or similar levels. So, JK, what do you think? What is going on? I mean, the kind of moves we are seeing is quite significant.
Yeah, definitely they are, Shikhar. The week has not really started well for the risk assets. And right at the start of the day, we had China cutting lending rates again. 1 week after they cut the rates, earlier. And now this cut in the LPR was, by 15 basis points. And while it is not a total surprise considering the Chinese economy status, it is further reiteration of government's concern to revive it as well as to support the slumping real estate sector. But the market took it as a signal to further sell the yuan, and near 10% fall in the yuan from the last year's strongest level of 630 is expected to help their export sector. But definitely investors are right now not interested in buying risk assets, and they are selling off. The outflows from China continues, and so far we haven't seen any official protest to these moves in the yuan as such. Then we had the fresh gas crisis in Europe, and this was after Russia state-owned energy Gazprom said it would shut down the single biggest piece of gas infrastructure for 3 days from the end of the month. The unscheduled maintenance work on the pipeline, which runs from Russia to Germany via Baltic Sea, deepens the gas dispute between the two countries and exacerbate both the risk of a recession and a winter shortage. And the front-month gas price at the Dutch TTF hub, European benchmark for natural gas trading, jumped 19% on Monday. And higher natural gas prices also rubbed off on the global crude prices. So no wonder the European markets slumped and the euro sliced through the parity very easily this time, and in fact broke below the previous low of 9950 and trades comfortably below it. So that's actually rubbed off on other markets as well. And the European and US markets were down to more than 2%, as you mentioned. Obviously, the Moscow blamed the faulty and delayed equipment for a drop in gas supplies, but Germany considers it as a political maneuver designed to sow uncertainty across the bloc and also to boost the energy prices. They have already been battling to shore up winter gas supplies amid growing fears that Moscow would soon turn off gas completely. So that's two major, risk of news for the markets, and global markets across fell. And the yields, of course, have been rising. That is because there is continued jitters ahead of the Jackson Hole symposium, as investors are selling stocks in a big way, reversing some of their recent hefty gains. Fed is getting concerned about the financial conditions which have eased recently, and that could negate the inflation fighting efforts of theirs through higher demand, and hence likely they will keep tightening rates further to rein in the inflation down to their target levels. Fed funds futures are now pricing in a 54.5% chance of a 75 basis point hike by the Fed in September. Even so, the losses, in both stocks and bonds kept the dollar on a bid tone. And I think Fed is more concerned that their actions so far should not go in vain, as the demand side can once again increase the inflationary pressure. So they are okay with asset markets falling further, and there is no better cue for the market to sell stocks than when the central bank indicates indirectly that they are okay with weaker asset markets. Of course, the Iranian nuclear deal also reaching a stage where only the US guys have to approve the terms. Europe is fine with the terms that is mentioned, and even Iran has reportedly given a reasonable go ahead with it. Now it's all up to the US. But the bad news, even if the Iran deal is signed, there is no joy in it, because OPEC already indicated that they could be cutting supplies to, offset the oil glut that can happen if the nuclear deal is signed. So that is not good for oil importing countries who would have harbored thoughts of having a easier condition. So it's the challenge for countries like India will definitely continue. For there is also news that Vladimir Putin and also the Chinese premier would be meeting or will be attending the G20 summit in November in Indonesia. And some reports indicated that even Ukraine President Zelensky might be attending the same. So it's not very significant right now in the short term, but definitely possibly market thinks that we are restarting the peace process. And that's something, if it really becomes a reality, then it would be a good thing for the market. Yeah, as I said, dollar has hit 109 once again, and just below the 109.30 level seen earlier in the year. And it's looking good for more, possibly psychological level of 110. And technically and fundamentally, it's nothing to indicate that this trend is changing. And the euro being below 19.50, any rallies will definitely be sold. And I think the conservative target on the euro should be around 0.97. Of course, euro is leading the whole pack of currencies. Yesterday, Latin American currencies were stable, but the Asian pack was definitely weaker, with Korean won, Chinese won, Indonesian rupiah all weakening, and Malaysian ringgit making all-time high. Of course, rupee stood out because market senses that RBI would not be, easy going on any break of 80 levels. But I think it is but natural that if euro continues to slide or the dollar index continues to go up, even RBI may not be averse to some more weakness in the USD-INR. So long as the break and the moves are not very volatile, and they would be okay with the orderly fall in the rupee. So we should expect an eventual break higher even in the USD-INR, maybe in baby steps. Perhaps 80, 20, 30 will be the initial move. But we'll see in Indian rupee, it's always depends on the flows, and flows are right now slightly favoring the inflows because we already had 47,000 crores of inflows this month. So all in all, it's a dollar strong scenario, risk off scenario, and events lined up or even more creating anxieties for the investors. So we'll see how it pans out in the coming days in the week. Thank you.
Okay, wonderful, JK. I mean, that was quite good, covering almost all of the globe. But what do we hear quite significantly is the another round of lending rate cuts by China. This not only enhances the concerns on the economic performance by the nation, but also influences the market participants' activity in the risk assets. And what do we hear on the European energy crisis front is the another gas crisis, which is pushing through the European nation, which has led to the correction in the currency. What do we await is further updates from all the nations and the nation's central banks in the Jackson Hole Symposium. But really glad to hear that out of the Asian pack of currencies, USD-INR was the standout performer in this route of currency moves. So we'll stay tuned for further round of updates. We catch up again tomorrow morning. Thank you for listening.